This presentation, which I'll try to roll through as quickly as I can, is basically something I started doing back in the year 2000 in the Silicon Valley. Startup 101, structuring for your company from formation to financing. I'm Joe Daniels, partner and co-chair of the Venture Capital Emerging Companies practice in McCarter in English. Let me just tell you a few things about McCarter. It's a 175-year-old full-service law firm. So we basically have a department for everything that a business needs, like real estate, tax, litigation, intellectual property, etc. I'm in the corporate group. We have over 400 lawyers and 9 offices throughout North America. But we have a global practice because we've been around for so long. We have lawyer or law firm friends all over the world that we do deals with. And I've been representing startup founders forever, including, or not I personally, but we have been representing startup founders for centuries, including Thomas Edison. I'm the co-chair of what I think is the highly ranked venture capital emerging companies practice. We basically focus on helping companies form in the correct way to be able to raise successive rounds of angel and venture financing, helping them expand through acquisitions and partnerships and commercial agreements of every type, and then helping them exit through merger, acquisition, or IPO. We're usually ranked by the principal league tables in our space, pretty high, called PitchBook, both regionally, nationally, and globally in terms of the number of angel and VC deals that we do every quarter and every year. It shows our focus. We represent thousands of startups and venture funds all across the nation and the world. Those are some of the names. And for example, like in 2020, we did about 184 deals for 7.2 billion in the startup space, about 147 on the company side, 37 on the investor side. So we see a lot of what I'm going to be talking about in this presentation. We also have a 120 plus IP group, lawyer IP group, which has specialists in every technical field, especially in technology and life sciences. And they handle the patent, trademark, and copyright prosecution, licensing, and litigation. And we have 100 litigators ready to sue and defend you all over the United States. I've been doing this for about 25 years. I basically joined the group in Palo Alto that took Netscape public and sold it to AOL back in the day. Here are some of the giant companies I've represented on the public company side, like Polycom, Informatica, Invitrogen, Monster Worldwide, Autodesk, and big venture funds and private equity funds and investment banks like Credit Suisse and Morgan Stanley. Done about 25 IPOs and follow-on offerings, scores of M&A deals, thousands of financings over this career. That's all I've done. Usually in tech and life sciences. So this is what we have in the agenda. What kind of company do you form? How do you protect the equity with vesting? How do you protect the IP with agreements and filings? What is IP generally in the United States? How do you protect it? And then how do you raise money? So let's start off with formation of a company. So this is a simple diagram. It shows that you're probably, as the founder, the person in the middle square, idea or biz dev person. You're contributing the business plan and other intangible assets to the company in exchange for stock. And then you add on other team members, technical personnel, people of every, skill, qualification, and it also usually in exchange for equity, but sometimes for cash. They provide the services and to the company. Company, is assigned all the intellectual property from all that labor, from both the middle square and the right-hand square. And then you see the investors putting in cash on the left-hand square. And the key is all this is aggregated in that one little box down below called the startup company. Cash, ideas, IP, and inventions, all that stuff. So when do you form that box or company? In my opinion, when you have more than one co-founder or another person involved. Why? Because you can have a dispute with that person and that person can say that they own more than you think they should, or dispute the ownership of the intellectual property of the company. And that can blow up the entire situation. Second, when you have a material contract or obligation to limit your own personal liability. You don't want to be personally on the hook for your WeWork license or any real obligation because you're starting to start a business and the law will protect you if you form a company to start that business. What is the type of company to form? This is an age-old question, but I always say that by the time you get to the age of like 3 or 4 years old in the Silicon Valley, you know it is a Delaware C corporation. And this is why. The principal reason why: the qualified small business stock exemption exempts the greater of, can you see my mouse cursor when I go like this on the screen? I think you can, right?
Yes.
It's like a pointer. It's the greater of $10 million or 10 times the purchase price that you pay for your stock is exempt from capital gains taxes. That's a lot of money, you know. So if an investor puts 10 million bucks into your company, that means $100 million is exempt from capital gains tax when they sell it. But the key is you have to hold C corporation stock for 5 years to be able to. So if you start out as an LLC, you start out as an S corp, all the time that you're one of those other types of companies, you're not counting towards the 5 years. So that's why everybody who knows what they're doing in this space, they form a C corp from the beginning. They forego any other ideas of what makes sense, and they just go for the C corp. Also, the angels and the venture capital firms that will be investing in you, that you really need their money to scale, they generally do not want to pass through vehicle like an LLC or an S corp. Because the gain and loss can go right straight into their company, right? So a venture fund will very often have not-for-profit investors, and that means that your profit, if you're an LLC, goes straight up to the fund and then straight up to the not-for-profit investor, which gives the not-for-profit investor a nasty penalty tax. So, and angels don't want to have to pay tax bills when you become profitable. They just want a big check at the end when you sell the company. So. Also, we reduced the corporate tax rate in the US to 21% in 2017. So that's a little bit of a break for corporations as well. In which state should you incorporate? Generally, the answer is always going to be Delaware. Despite what anyone may tell you, and there's all kinds of people out there who say all kinds of things, but I just tell you, I'll just to sum it up. Why? Well, I mean, look at it. 90% of new IPO companies are Delaware corporations. Why? In my opinion, because all the investors, the bankers, and the lawyers who work on that IPO have memorized Delaware law and are absolutely certain what the rights and obligations of stockholders, directors, officers, et cetera, are in Delaware. Whereas we don't know what those things are, what those rights are, what those obligations are in all of the other states, whether it's Nevada, Maryland, DC. I don't even know if you can incorporate in DC, but maybe after it becomes a state, right? So just go with Delaware. Take my word for it. If you want to talk about it, if you have any questions about it, you feel free to email me and I'll explain it ad nauseum. So once you're a Delaware C corp, I wanted to run through, what are the basic players inside of a Delaware C corp. First, the stockholders, the people who own the company, the economics, and also control the people who are elected to be on the board of directors. The owners of the company. Keep in mind, as when you're a founder stockholder, that with a Delaware corporation, it is not essential for you to retain majority ownership in order to retain control. It is important for you to retain control of the board of directors in order to retain control. And the way that we do this, when investors come in and they ask for a board seat and they ask for more, all these different rights and this and that and the other, they ask for a lot of stuff, right? Is to enter into voting agreements with them, which has all of the stockholders agree who's going to be on the board, right? So you could have 2% of the company as the founder and still control the board with that kind of voting agreement. And that is, I'm not saying that's common, but it is common for founders to get diluted to 20 or 30% of the company before a priced equity round, and through the voting agreement, they still retain control. Just keep that in mind. What is the board of directors? The board of directors controls all the major corporate actions: selling the company, issuing stock, hiring and firing of C-level officers. And just having one director is fine until investors start asking you for board seats. And you also want to try to avoid deadlock in all cases. So imagine you're the founder CEO. You start off, you're the sole director of the corporation. And then an investor comes along, wants to write you a couple $1 million check, but they want a board seat. So that means you need to have somebody to outnumber them with. You need to put on a friend on the board if you want to retain control. So you have to start developing relationships with the right people that would be appropriate to sit on the board and basically vote in your favor implicitly, right? Officers, they're in control of the company day to day, CEO, CMO, CTO, et cetera. And advisors, a lot of people say they want to provide you guidance in exchange for equity, and they say, I think I should be on your board. That is often a ploy for control of the operation rather than really honestly just trying to give advice for equity. So make those people advisors instead of directors, and give them a small equity grant as compensation for that service. Okay, there's two major types of agreements that you should put in place before you try to raise money. Number one, equity documents, and number two, service agreements. So let's start with equity documents. So why do you need to have documents that show what your equity split is between your founders? Mostly to avoid disputes. Like I said in the beginning, that's why you form a company. So because I've seen too many times co-founders disagreeing on how much each of them owns, or they change their mind. They try to retrade, renegotiate when you actually get around to finally putting it in writing. So the sooner you put it in writing, the better. A lot of people are afraid to do that because they're afraid to give people a big chunk of their company. And the solution to that is a couple slides down, something called vesting. We'll talk about that. There's also a tax issue. If you paper your equity grants too close to an equity financing, you may inadvertently be creating ordinary income for yourself and everybody else who's in the cap table, and nobody wants ordinary income for nothing. Also, investors are all going to want this documented anyway, so just put these documents in place. That's what the what is, board approval and stock purchase or option agreement. These are standard forms. It's easy. You can get it done very cost effectively with the right kind of counsel. There's basically two types of equity grants: restricted stock and stock options. The basic point that you want to keep in mind is that really up until the time that you raise an equity financing, meaning selling preferred stock, just grant restricted stock. It's a much better deal for everybody involved. It may even be a better deal after you do the price equity round. But the basic idea is that everyone's going to get it for free. And then when the company exits, they're going to be able to sell that stock and only pay capital gains tax. Just keep in mind, if it's vesting over time, you have to file this thing with the IRS called the 83B election within 30 days of them buying the stock. That's sort of a technicality that you have to pay attention to, but this is overall a much better tax deal. Remember that qualified small business stock exemption also would exempt this restricted stock, for the first 10 million or 10x, whatever your purchase price is. And then after you raise that price equity round, you grant options, right? So before, it's basically the dividing line is the first priced equity. Before that, restricted stock. After that, options. An option is an option to purchase stock at the fair market value of that stock on the date that the option is granted. And usually that's determined by something called a 409A appraisal. If you granted it lower than that price, then you're again potentially giving ordinary income to the recipient. So you want to be careful with the pricing of your options.
Hey, Joe.
Okay, the key content.
Can we ask questions along the way? Sorry, one quick question. You had mentioned earlier a 5-year period to get the special tax rate. Yeah. So does that start from the 30 days of the 83B being filed?
Yes. Well, no, it starts 30 days from the date of the stock purchase agreement, and then the 83B has to be filed within 30 days of the date of the stock purchase agreement.
Got it. Okay.
Yep. Okay, the other major concept about equity is that all shares in your company should vest. Seems, counterintuitive for the people who are the key founders, right? Why should I put vesting on myself? That means the VCs can fire me and take back some of my stock. That's a fair point, but keep in mind that in the beginning of your company, you're going to have control of the board. And if you followed my advice, you'll try to retain it as long as you can. So that means by the time any control you give up control, you'll be fully vested, and you can tell everybody else at the company that everybody at this company is vesting, including me, on my typical founder schedule, which by the way is a 3-year, 1-year cliff, or 1/3 after 1 year, 1/36 each month after that. People who join later, like employees or consultants, the typical schedule is a 4-year, 1-year cliff, or 25% after 1 year, 1/48 each month after that. And for directors and advisors, it's usually a 2-year monthly vest, 1/24 a month. Why is vesting so important? Think about it. You have 3 co-founders, each with a third of the company each, and one of them leaves two months after you found the company. Do they still deserve a third of the company? No. You should be able to buy back some of their stock, maybe all of their stock, right? So it's an incentive for people to stick around and keep working and performing the duties they said they were going to perform. Investors obviously want all the team members to vest over time because they want to also lock in the incentive for them to continue working on the company. Okay, the next big type of agreement. Yeah, go ahead.
There's a few questions in the chat box. One is, how are stock options decided and granted?
So, you know, at the early stage of a company, the percentage of an equity grant is usually determined subjectively, right? Based on, you know, what a CTO will typically get for a company at that stage. And it's all thought of in terms of the percentage of the company, right? So depending upon the stage of the company, you know, you could say CTO should be getting 5%, CEO should be getting, if you hire a professional CEO after the founders, you know, 10%. And there's all kinds of materials out there. There's equity calculators. You could tell me the specific facts, and then I could tell you what I think. But there's a lot of information out there. Just Google it.
Yeah, Joe, this is Anand here. If you don't mind, can I ask you a question, please? Just as a follow-up.
Yep.
So my query is, what percentage of the share base are usually allocated for stock options? That's number one. And number two is, for an advisor, what's the trend in the US startup companies for stock options?
Okay. Sure. So remember, before the first priced equity round, typically in the US, you don't need to adopt any equity pool or option plan, right? You just grant that restricted stock because that's the best tax deal for everybody. Then after that priced equity round, or as part of it, usually you adopt a plan that's 10% of the post-money valuation. It's usually 10%. Sometimes it's as much as 15%. Sometimes people negotiate it down because usually the founders take the dilution on that pool. But I would just wait until you negotiate your first priced equity round and then negotiate that term. But it's usually 10%. In terms of, what was the second question? Trying to remember.
The second question was basically, I think you just answered, it's 10%, right? That's what you answered.
Yeah, well, no, the second question was like, what's typical for advisors? And I would say that what's typical for advisors in the US is a grant between 0 and 1%. And there's this excellent advisor agreement produced by this thing called the Founders Institute, called the FAST form, F-A-S-T.
Okay.
And it has a matrix in the back of the percentage that, you know, depending upon the skill level of the advisor and the stage of the company, it's like a graph or a matrix of percentage. You can find that online. It's a pretty good guide.
So advisors typically get 1% of the company. That is a trend in the US. Okay.
0 to 1%.
Yeah, I said 0 to 1%. Yeah.
0 to 1%. And is there any implication on the tax when this is converted into shares and then it's redeemed?
Can you say that again? Didn't understand.
Do you have, can you share any insights on the tax for basically any of these stock options once they are exercised? And let's say the company goes IPO or the company is acquired, or if the advisor wishes to exit and then he is paid, is there an implication of tax?
There's two categories of options in the US, and that's incentive stock options and non-qualified stock options. So for these, and the incentive stock options are reserved exclusively for employees. Contractors, directors, advisors, these people cannot get ISOs. The ISO is the better deal. And basically there's no tax impact on grant or exercise. You know, as long as you have held the option for 1 year from the date of grant and then exercise. And then thankfully, if you hold the underlying stock for 1 year from the date of exercise, then it's only taxed at a capital gains rate. The likelihood of achieving both those conditions is low, because usually options are cashed out in an M&A deal, or sold, exercised and sold on the same day in an IPO. So usually the net effect of an option is you recognize the difference between your sales price and the exercise price as ordinary income. And then the non-qualified option, it doesn't matter what you do in terms of holding periods, it's always going to be ordinary income. So that's why the restricted stock is good. Option is the next best thing, but not as good, right? It's taxed at the ordinary income rate. The restricted stock is taxed at the capital gains rate. Okay, enough on equity though. We got to move on to service agreements. This is the second probably most important thing to document when you form a company. Keep in mind that all personnel should sign a service agreement when they join. We usually categorize personnel in the US in 4 different groups: employees, consultants, interns, and advisors. Advisors are really consultants, so it's really just 3 groups. And the laws are different with respect to each category, so you have to have a different form for each of those people for every state, because we have 50 states in the US. They're very, very similar, but there's sometimes key differences. Each of those forms achieve 3 important things. Number 1, it requires the personnel to not disclose your confidential information, many of which could be trade secrets. If they disclose your trade secret, it's no longer a trade secret. And also they can't use it for any purpose other than working on your company. They can't take it to a competitor and use it there. It also requires all inventions that they create are assigned over to the company, right? That way they can't take the position that they own the IP if they leave. And it prohibits the personnel from stealing your customers and suppliers or speaking negatively about you and the company when they leave. And the reason why you want all these protections in your documents, service agreements, is because all these personnel will typically do that in the United States. They'll do all these things, which can be extremely harmful to your company, right? So if you have these agreements and they go to a better finance, competitor with better resources, and they begin to compete with you using your trade secrets and stealing all your IP and customers and everything, then you can send a letter to the person that left your team as well as the competitor, asking them to cease and desist, and it's much more effective. Also, try to tie equity vesting in the equity docs to provision of services under the service agreement, so it's very clear what they're supposed to do in exchange for earning the stock. Okay, just a couple more things, in terms of documentation or steps to take before you raise money, other than the operational things of like creating a lot of revenue and all that stuff. So number 1, use non-disclosure agreements to protect your trade secrets. Number 2, consider filing for patent, trademark, and copyright protection. We're going to go through some of that. And then have your material contracts, like the ones listed, your terms of use and privacy policy should be looked at by good lawyers before you launch or before you get significant traffic into any kind of website. Your customer, supplier, distributor, or affiliate agreements involving any of your intellectual property should be looked at to make sure that you're not inadvertently like giving away your IP when you're doing deals with those counterparties. And you want to try to resolve your major regulatory issues. If you're going to be a healthcare company, then you have to understand your regulatory pathway. If not, if you haven't been, granted emergency use authorization from the FDA, at the very least, you know how to get that, right? So you can explain it to investors. I'm just going to quickly run through, since we have a remaining half an hour, like a general set of concepts about the 4 areas of intellectual property in the United States and pretty much all over the world.
Can I just ask one question? Is there a standard service agreement like the one founders that you mentioned?
Yeah, so that one Founders Institute FAST agreement is for advisors. That's one of the 4 categories that I had in the other slide.
Yeah.
I don't know where it is. Yeah, but you need a separate form for consultants, for interns, and for employees, because the laws are different.
Okay.
But yeah, there's a form for all of those. That's the key.
Okay, thanks.
Yep. So 4 areas of IP law. You've heard of them before: patents, copyrights, trademarks, trade secrets. So what is a patent? It gives the holder an exclusive right for 20 years in the US to prevent others, and that's pretty much the same all over the world, from making, using, selling, offering to sell, or importing the patented invention. There's a balancing act when you file for and then are even issued a patent, which is that when you're issued that patent, even when you just file the full application, you're disclosing exactly how you achieve whatever the goal of your technology is to the public. That tells them exactly how to work around the patent and how they might, create a similar invention that would address their commercial need or solution. But the benefit is that you get a limited, 20-year monopoly. And then there's this first to file issue in the US, which is that, let's say you invent something, it's great, you incorporate it in your business, but other people reverse engineer what you're doing, and then they file a patent on it. So even though you were using it first, they have a potential claim to, and maybe actually get issued a patent on your invention first, and then be able to sue you for patent infringement. So there's more of an incentive these days to file patents, bottom line. And what I usually recommend, and what is common with early stage companies, is that people file a provisional patent application. It's pending for a year. You don't have, it's a smaller filing fee, smaller legal fees. You don't have to negotiate with the US Patent and Trademark Office. And then you follow up in a year if you really want to follow through with a utility or a design patent. Here's an example of those. The utility patent is patenting the way an invention works, as I say. And this is an example of the system and method for detecting and tracking features and images. You can see the decision tree here. It goes on for multiple pages after this, but just making the distinction between this is a patent on utility, this is a patent on design, which is patenting just the USB flash drive housing depicted here in the diagram. Two types of patents, utility and design. So what I usually recommend to my clients is that they just get a free consultation from a patent prosecutor in an area that, someone who's an expert in the area in which your technology resides, right? They're going to know about all the other patents in the space, or many of them, and they can help you, do a search to determine whether or not you're infringing someone else's patent, or whether it makes sense for you to file a patent, how much it's going to cost, and all that. Next, copyrights. So the purpose of a copyright is to protect works of authorship, things in your head like music and books, stories, ideas for a film, into a fixed form, right? You can't just have it in your head. You have to reduce it to practice in a fixed form. It prevents people from taking that fixed form and without your consent, copying and distributing it, displaying it, okay? So obviously you see copyright on things like these slides. Unfortunately, my team did not put that on there. It's a mistake, but you should always put this Circle C, date of publication, and copyright owner, Joe Daniels in this case, should be down there at the bottom because this is a copyrightable material. Similarly, you put that on websites, you put it on films, books, and you can file for federal registration by uploading the content to the US Patent and Trademark Office. Registering with the US Patent and Trademark Office on the federal level allows you to file a claim for statutory damages and attorney's fees in federal court. And it's very difficult to defend against this when it's proven that someone has infringed your copyrights. Trademarks. Trademarks are names, logos, designs, and sounds that identify the source of goods and services. And what I usually recommend to my clients is that when they develop a product name or a company name that they think will be a real brand, is that they do at least a Google search and go down 20 pages and identify anyone who's operating in the same space as you under the same name, same brand, same design or sound, so that they are not going to ask you to cease and desist and potentially sue you when you launch. You can take that a step, where there's a substantial likelihood of confusion, or that's a legal term of art, between, likelihood of confusion between the mark that you want to use and what somebody else has already been using for many years and may have a trademark on, right? The next step would be to do a trademark search, formal search of databases for like $700, have an attorney look through it, and then you can be confident that you're safe to operate, or probably safe to operate. And then the next level is, if you really like that mark and you want to spend the money, a few $1,000s, you actually file for a trademark, and that prevents anyone else from using that trademark in all 50 states. Until you make that filing, your use of a mark gets you common law trademark rights in the states in which you've used it to sell your goods and services. Trade secrets. The classic example of a trade secret is the formula for Coca-Cola, which is, that formula derives independent economic value and is subject to reasonable efforts to protect it from disclosure. Those are the two requirements for a trade secret. The reasonable efforts to protect the technology from disclosure are that the formula for Coke is located in a bank vault across the street from the headquarters of Coca-Cola in Atlanta. What do you do with trade secrets? You just keep them secret. And if you're going to give any personnel access to those trade secrets, they should sign an NDA or one of those service agreements I was talking about. And use encryption, use password protection on folders, all the typical things that you do to keep things secret. Because when it's no longer a secret, if you publish it inadvertently, you don't own it anymore. The world does.
Joe,
Any questions on IP?
There's a question on if you create IP based on someone else's IP, who owns what? And can an owner be an individual or a company?
If you create IP based on someone else's IP, if that person has not protected it with the appropriate filings or paperwork, then you may have a claim to owning that IP. That's the short answer.
Joe, the question was, for example, if there was a patent on springs that are used in a bed, and now I want to use springs in a chair, I'm creating new IP, same kind of a deal, but that the guy never wanted to use it for chairs. He was only focusing on bed.
Yeah, that's a good example. The bottom line is it depends on the claims that are in the patent on the springs for the bed. If the claims in the patent for the springs for the bed also cover chairs and other things that support the human body, or maybe just all things that support the human body, then technically the chair would be infringing the first patent, right? Or possibly, right? These things are very technical, and you have to get patent lawyers and prosecutors to look at all that stuff. But that's the basic idea. And with respect to IP, can it be owned by an individual or a company? The answer is yes. It can be owned by either one. And that's why those service agreements are important. Because, for example, if you are a US software company and you have like 50 developers in India coding all day long, developing your software, then you need to have a service agreement directly with each of those people to make sure that the IP, the code they're creating, is assigned over to that company, right? Otherwise, they own it themselves as individuals under both US and Indian law, as an example.
My question was, I think specifically to copyright, when you said, hey, put your name with a copyright, I was wondering, can it be a company instead of you personally?
Yeah. And of course, my firm would prefer that it would be copyright 2021 McCarter in English as opposed to Joe Daniels. But I like to just put Joe Daniels there because I might go to a different firm, right? I'm the one who made this thing, so it belongs to me. You probably have an alternative claim.
Okay.
So here we have fundraising. So how do founders in the United States raise money at an early stage? We usually divide it up into this concept of the pre-seed financing and the seed financing. Pre-seed is where you're raising, $50,000 to $750,000, maybe $1 million, selling 1 to 15% of the company. And what people are looking for what usually sells investors is where you have a strong founding team that knows their industry, or at least sounds like they do. And some demonstrated product market fit, whether that's a great deck or a video, it's obvious, here's the product, here's the problem, this is the solution, amazing, it's obvious, or something that's more, unknown, where like enterprise software, like, I don't know if these 300 companies are going to be interested, but you have LOIs with 25 of them saying, I'd love to use this product if somebody built it. That's what I mean by product market fit evidence. And then once you've raised that pre-seed and you've gone to the next level and created some traction, you do the seed financing. So usually you're raising $750K to about $10 million for 5 to 33% of the company. Those are just like median numbers, but that's your typical seed rounds. And sometimes seed rounds are more than one because you have to raise enough money to, you might have to pivot or whatever it takes to get to the operational metrics for the next round of funding, which is usually called the A round, right? So seed financings or seed financings usually up to about $10 million. Some there are very often also 20 million, 30 million. And what people are looking for in those deals is not only the strong founders and apparent product market fit, but also meaningful traction, meaning usually at least $10,000 in revenue a month these days, depending upon the industry and everything about the company, and as much as $1 million a year, so 83 grand a month. Usually those are the bare minimum operational metrics people are looking at for this kind of financing. And in those deals, the investors are usually angels or early stage VCs. So usually my clients will go out with a deck and they'll pitch people and they'll come back and say, look, these investors are really interested, and they ask me, what are my terms? What do I say? And what I do is I usually just ask a few questions about the company, like, how's the product doing? What's your revenue like? How big's the team? Who's on the team? Let me see your deck. And then I look at all that, and then I'll say, well, I think you should do a convertible note, a SAFE, or preferred stock. One other quite major question is, how much are you trying to raise? And then I put together a structure, and we either just produce the security or a term sheet, and the investors look at that. The company sends it to the investors. They look at that and they say, yeah, that makes sense, and they'll negotiate it, and then they send in the money or a check, and you sign and close. Simple as that. Sometimes you have to produce a bunch of documents if it's a preferred stock deal. That's what I call a company, or that's what everybody calls really a company-led round, as opposed to the situation where, and sometimes this happens in a seed round, the lead VC just issues a term sheet and says, take it or leave it, right? And you try to negotiate certain things, but so those are the two ways it can go, company-led or VC-led. And next, what are the popular ways that people raise money?
I have a question.
In these markets.
Can I ask
Sure.
Joe, can I ask a question, please?
Sure, go ahead.
Joe, a lead investor, is it necessary for him to take, or for that company to take a majority chunk of the round that is being raised, or can it be about 20-25% of the round that is being raised? Any guidance?
Yeah, I think it's usually more than 20%. It does not have to be a majority. I'm just thinking about the rounds I'm working on right now. In fact, in most of those cases, it's not a majority, but it's like a big chunk. So for example, 9 out of 20 or 13 out of 50, trying to think of what else, 600K out of 1.5. Does that make sense?
That's about 40%, 40% of the round.
Yeah. And sometimes they want to take the whole round. It all depends on the situation, but it's usually a good percentage. So let's talk about the different types of financing structure. Oh, go ahead. Another question?
Yeah, because I'm leading a round right now in the US for a digital health company. And I got a feedback from the founder that there are other investors who would want the lead investor to take more than 25% of the round. So that's the reason I asked this question. What's the trend?
Yeah, no, like I said, I think, yeah, I think it's usually greater than 25%, but I haven't done the math on in the exact case studies that I just cited to you, but I think those are all over 25%, right? Especially when the dollar amount raised is less than 20 million or 20 million or less, then it's definitely going to be more than 25% usually.
Thank you.
But he could just be trying to get you to invest more money, you know? Maybe you should say, who are those investors? I'd be happy to discuss it with them, you know? Okay, so convertible notes, safes, and series seed preferred stock are the main types of ways people raise money. Why would it be convertible note or safe? What is that stuff? Well, the basic reason for these things, and these are like shorter, you know, one document, 5 to 10 pages. The main reasons why people raise a lot of money. I mean, probably about, you know, 35 billion a year in the US is because you don't have to set the valuation. So the investors, like that guy who was just on asking me a question, maybe he thinks your company is worth 4 million pre-money and you think it's worth 10 million pre-money. So how do you meet in the middle? You know, you can't really split the baby and all of a sudden his price goes up by 30%. He's not going to like that. So instead, just go for a convertible note or safe and you don't have to set the price. It's also cheaper to produce that document, that one document, instead of the full preferred stock documents, which, you know, it's why I make the big bucks, you know, because it can be like 50 to 100 pages and there's a lot of negotiation. And, you know, after you sell those notes and safes, you can still issue that restricted stock. It goes full circle. The restricted stock is the better deal for your team. You can even issue it to yourself. And, you know, it's incorporated into the formula of the note in the safe, but you don't have to worry about tax issues. Why would you go with a series seed? Mostly because the investors demand it. You know, they'll say, I don't want a variable price. I don't want to buy a note or a safe. I want to set the valuation. It's going to have to be, you know, between like where the hypothetical of 3 and the 5, you know, it's going to have to be 5 as high as I'll go, and then you accept it, right? Or maybe you have like 2 million of convertible notes outstanding and you want to convert them all. So you, you know, raise the minimum amount to convert them, and then they convert into stock, and they can no longer complain, I want my money back. What are the typical terms of a convertible note? What's the basic idea? Basic idea is that the principal amount, possibly the interest of that note, converts automatically into the next equity round, the next equity financing. The note in the safe is not an equity financing. It is, but that's not, you know, we don't call it that. So minimum priced equity round is usually a little bit more than you're raising in notes and safes. So if you're raising 500K in notes and safes, let's say, or just one or the other, notes or safes, maybe the conversion trigger would be 750 or $1 million. And the concept is to the investor, I'm going to piggyback on the great deal that these big equity investors invest $1 million or $2 million at, because I'm going to get a discount. I'm going to invest the money now, but the bet, you know, the time value of money return that I'm getting is, let's say, a 25% discount to the round price. So if you later raise that equity round for $1 million at $1, the note holder gets in at 75 cents, right? Nice, you get more shares that way, right? But then people begin to realize, well, I invest all this money at an early stage when I think the valuation is worth 3 million, and then they build a company that's worth 20 million, and I have a 25% discount, so I'm still getting in at 15 million, which is way higher than I thought it was worth when I gave them the money. So they took all the benefit from that. So instead of just a discount, why don't we cap that at, say, you know, 6 million? I think it's worth 3, you think it's worth 10, let's cap it at 6. That way, if you raise at 5, I get in at 5. If you raise at 8 or 10 or 20, I still get in at 5, right? And you can also set it as a fixed price. Those are the major economic terms of a note. You want to, as a founder, you want to try to offer just discount only, which usually only works with unsophisticated, or, you know, investors, or where your company's really hot. Next, go for a cap, but not both, because then the investors have it both ways. The principal amount will determine what percentage of the company the note holders convert into. The interest rate, usually 2 to 4% these days, and the term is usually 1 year to 2 years on a note. There's also a, you know, most of the pre-seed and seed round money raised. Yep, go ahead.
What is the downside of a convertible note, and from both investor and founder perspective? And is this synonymous with debt, for a short-term debt?
Well, it's not synonymous with short-term debt because it automatically converts into equity. Like what if you go and you raise that equity financing, the convertible note turns into the same stock that you raise in that equity round. So it's, whereas short-term debt, it's basically here, I'll give you some money, you have to pay me back plus interest within 12 months or 24 months. It's a hybrid of that short-term debt and the equity. What's the pros and cons? So the benefit to a note to the founder is, again, what I said in this slide. You don't have to set the valuation, and it's cheap from a legal fees perspective to put it out there. The benefit to the investor is that you're promising to pay the money back after 12 months to 24 months if you do not raise the equity round and it doesn't convert into it, or if there's not a change of control, right? The downside to the founder is that in 12 to 24 months, some investor is going to be able to say, I want my money back, all at the same time, right? That's a problem. So if you didn't raise the equity round, you have this people with a hammer over your head, asking for the money back. So the solution that was engineered in the Silicon Valley is the simple agreement for future equity. The SAFE is the exact same thing as a note, but it has no maturity date and no interest rate. Okay, so why would you can understand why founders love this, right? There's no maturity date, so I have forever to raise my equity round, and then whenever I do, then they convert, right? Why do investors like it? Well, because most of the people that invest 100 grand, 150, 250K into angel investments, they have $10 million plus. So, they're sort of gambling with a small amount of their overall net worth. Obviously, other people don't have 10 million and they still do it, but whatever, the majority of them are 10 million plus. So the last thing they want when they speculate on these deals is for some guy, like if you're, investing 100 grand along with 10 other investors who invest 100 grand in $1 million round, you don't want 2 or 3 of them to say, I want my money back after 2 years or 18 months. And then that blows up their operating plan to, launch a product or to raise another round of financing. You want the company to have that runway or wiggle room to go out and raise that additional round, or complete the operational plan, raise another round, and then you convert it. That investor converts into equity. That was the plan for that investor the whole time, was to convert into equity. They were just going along with the company plan of not setting the valuation, right? So these speculative investors, they don't need the promise of getting their money back. Problem is, though, in certain parts of the country, certain types of investors, they don't like that. They prefer having the 12 to 24 month maturity date. If that's the case, then you have to go back to the convertible note. So those are the sort of the short form ways of raising money for a startup in the US. Then we move on to preferred stock. We're almost done. So what is preferred stock? So SpaceX is on the Series N, as in North preferred stock. That means they went from A, B, C, D, E, F, G, H, so on and so forth. And their current valuation is, I think, 74 billion. And they just raised 880 million in their Series N round of financing, right? So, what's the difference between Series C preferred stock and Series N preferred stock? Mostly differences in the rights that are listed here, right? So the first thing and the most important term of any preferred stock financing is the pre-money valuation, because that determines what percentage of the company investors buy. So if you're if you're selling or raising $2 million on an 8 million pre-money, then you're selling 20% of the company, because 2 over the sum of 8 and 2, which is 10, 2 over 10 is 20%, right? 10 million is the post money when you're raising 2 million on an 8 million pre-money. Sounds pretty simple, right? You could probably figure that out. 5 on 15 is 25%, right? Like, it's not, that's venture math right there, but it gets complicated because let's say that you issued a bunch of notes and safes, $1 million or 2 of that. A very common negotiation is, do the shares issuable upon conversion of the notes get included in the pre-money or the post-money? If it's included in the pre-money, then common stock or founders take all the dilution on those shares. If it's included in the post-money, which I believe is more commonplace or market, but many investors will tell you exactly the opposite. then the investors and the common and the founders share that dilution on all those shares, right? What if it says in the term sheet that the investors want you to adopt a 10% option pool in connection with the equity investment, and that's all included in the premium. That again takes your valuation down from 8 million to 7.2 million, right? All these things, these price lowering techniques, are included in term sheets to, so you agree with the VC, like on the phone or in person, yeah, 8.5 million pre-money. But then you get a term sheet and it has all these terms. So you have to have somebody look at it, basically, the bottom line, and negotiate those items. Also, the amount that's invested, of course, determines the percentage that the investor is going to own. There is typically a liquidation preference on preferred stock, and that preference in like 99.99% of cases is 1x non-participating, period. No exception. Series seed, it's almost 100%, I think, except for situations where someone was taken advantage of, right? Same thing for Series A and B. It really only starts to switch over in a very small percentage in B, some to maybe up to like 3% in Series C. This may change in the market, but this is the way it's been for 15 years or something. So when you see a term sheet that comes back with 2x liquidation preference or 1x participating, look out. I'm not going to go through the mathematics. I can go through hypos, and we have a lot of time. Bottom line is, if you give up anything more than 1x, or if you give up participation, your return will probably be decreased on your common stock as a founder. You usually you don't give out board seats in a seed round, but if you do, then you should only give up a minority of the board. You should keep a majority so that you can retain control. I more commonly see that seed round investors are asking for an observer seat rather than a board seat. Preferred stockholders will also very commonly get a bunch of blocking rights: the right to block raising new money, selling the company, declaring a dividend, just changing the size of the board, which can, of course, dilute the board seat that they negotiated if you increase the size of the board. This can have a dramatic effect on your company's life. If you can't raise any more money, then you have to shut down, right? And I've actually seen a family office just reject any new financing, no matter what, arbitrarily, because they were angry with the CEO founder, and that that company did eventually have to sell at a low valuation. It was in trouble, right? Could not raise new money. So how do you address that? You try to negotiate the smallest possible list, or you put in things like, well, you don't get a blocking right if I'm raising over money at over a particular valuation or selling the company over a particular price. And finally, there's usually no anti-dilution protection in the Series seed rounds. On the East Coast, people tend to try to negotiate that more because Series seed has sort of become like the new Series A round. And A rounds would typically have that. Any dilution protection means there's an adjustment to the conversion price of the preferred stock, so it converts into more shares if you issue shares at a lower price than the preferred stock was issued at. It's complicated, but usually you don't have to give it up at this stage. So, and then just a quickie note on other early stage financing methods. SBIR grants and government grants for people who can get them are spectacular non-dilutive financing methods, and you should go out and apply for everything you can get in that category. And then finally, crowdfunding. Crowdfunding is raising a lot of money for a lot of different types of companies. I've included what I think are the top three. Actually, crowdfunding is out now.
I think you missed one, Joe.
Yeah.
Ignite social
impact capital. Yeah, I have to update
impact.
this.
Yeah.
Ignite
so
social impact. Yeah. Ignite social impact. WeFunder, Seed Invest, Art Engine. They're raising a lot of money through these deals, and do not ignore this as a possible option. There's all kinds of naysayers. I wouldn't listen to them. If you think you can raise money this way, then by all means go for it. And that's it. That's all I've got today. Any other questions?
So Joe, I think we'll have to, if it's okay with you, have a follow-on session. We've gotten a lot of comments in the chat box, and there certainly are more questions. So maybe if we could schedule something for next week, or if you have some time, that would be great.
Yeah, sure. You could just direct people to my direction. You should think of me, everyone, as a resource to the cohort or group, and happy to help with anything.
Perfect.
Hey, Joe, can you supply your contact information in the chat or maybe send it to the team?
Yeah, sure. I'll do that right now.
Thank you, Joe. That
Joe,
was a great
thank you very
presentation.
much. One of the best presentations. This is Anand from Singapore. Just loved the way you articulated everything.
Oh, thank you very much. It's been 21 years under development, so I guess that shows a little bit.
No, but though you are 21 years, you didn't complicate matters. I've seen so many experts complicate things. The beauty of this presentation, and I want to thank Rosemary for this, is that your presentation is so simple, you know, and simplicity is the ultimate sophistication.
Yeah, it could be made a lot more complicated, and it took me 21 years to make it that simple. So, God bless America.
Thank you, Joe.
Okay, see you later, guys.